The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Welcome to this session on GST. GST is really the hot topic these days. You see everyone talking about GST. Not only the newspapers, not only the television, but everyone that you meet, from the pan wala to taxi wala to businessmen to stockbrokers, and of course, people who are involved with diamond and jewelry industry as well, like everyone else. GST has touched every single person in the country, be it directly or be it indirectly. And it's definitely the biggest tax reform, there's no doubt about it. I would say it's impossible to talk about GST in 35-40 minutes. However, we'll give it a shot. What we are going to do is tell you some of the technical parts of GST, and these are based on principles rather than getting into minute details. Like any other law, probably in many places around the country or even in some other countries, this law also has several nuances, many intricacies. So we'll try to focus on the big things, the big principles, because from those principles, one can look at the procedures which are constantly changing. Even after the GST triggering in on 1st July, we have had numerous changes, including many reliefs. So let's look at some of those principles, and we won't go into minute details. My name is Raman, and I have been in practice as a chartered accountant for 20 years now. And it's my pleasure to talk about this topic on this forum. So what we will look at today is some of these things. The first one would be why GST, and that's very important because then we can appreciate why we have this law in the first place. Until we know why we have something, how it works and what it is, doesn't make full sense. We will also talk about what is GST, obviously, how it applies, what are the rates, what are the key concepts, how taxability works, how the credit flow works, how the procedural part works, which means the returns, which means invoicing, which means the effect on import, job work, export, and of course some points which relate to your industry. So first, let's look at why GST. When we look at the history of independent India, the constitution divided the right of taxing to the center as well as to the state. And we are both all aware that how these right to tax has worked so far. We had the excise duty for manufacturers, and we had the service tax since 94 on people who would provide service. The states, which are 29 in number today, and we have 7 union territories, those would tax goods when they were sold. So we had tax on manufacturing, we had tax on provision of service, which you can say is an equivalent of manufacturing, and we had the sale of goods, which were taxed when those sale happened, and these taxes were sitting on top of one another. So we had actually too many taxes. In addition to these, for the longest ever, we had the octroi duty, where when goods entered, say the city of Mumbai, we would pay octroi duty on it. And there was a huge nuisance at the border. And of course, a lot of irregularities in collection and unease of doing business. So all these different taxes have now been subsumed, have been merged, or all these have been done away with, and the only tax that remains is GST. The other part about earlier regime was a lot of these taxes had different rates. So many rates depending on the type of product. Those rates kept changing. Of course, when you imported certain things, there was the customs duty, and on top of it, you had a bunch of other taxes. And then you would look at how they would be treated in each state. So, if two states had different rates on, say, sale of goods, then the pricing could differ. For example, we know the fact that Goa let go of sales tax on, say, petrol and diesel, and that just made petrol and diesel so much more cheaper in Goa. So everyone on the border would just cross the border, get their cars filled with petrol or diesel, get their trucks loaded with fuel, and then come back out. So this would also result in unhealthy tax competition among states. There were also instances where states would give tax benefits. So a lot of industries would just rush and set up shop in those states. And obviously that's not a good idea because people are doing business because of tax breaks. And that doesn't serve the country well, nor does it serve the industry well in the long term. The other bad part of the earlier regime, not bad, but rather inefficient part of the earlier regime was that the taxes didn't talk to one another. And it's not just the departments that were set up separately, but the credit flow never moved. For example, if somebody manufactured, say, a pen, there would be excise duty on manufacture of that pen. On top of it, there would also be, at the time of sale, there would be VAT levied on it. And then that, excise duty paid, VAT duty paid item would be sold to the eventual consumer. Now, if there were people in that entire chain, which would involve stockists, distributors, and others, then excise duty credit was not available for payment of VAT, and payment of VAT was not available for payment of excise duty. If, say, a product was purchased on which VAT was levied, and then it was used to manufacture something else, and then it went out as a eventual final product, then VAT was not available to be set off. So these two taxes did not talk to one another. And that would obviously lead to rise in pricing because the costs would go up. And also the departments did not speak to one another because VAT had a filing mechanism, excise had its own filing mechanism. Of course, excise and service tax work together because they fell within the same department under the central government. And the VAT was a state subject. Also, this led to multiple compliances. For example, you had to file your tax returns under each of these regimes, each of these taxes on different portals in different formats, and supply your data on a monthly, quarterly basis as may be required. The consequence of all this was that yes, the products had different prices, the products had different tax rates, and there were many rates, and they all worked on different platforms. So, as a businessman, you had to deal with all these government agencies to do business. This also led to a lot of barriers to entry. So, although India is a democracy, at the state, every state wanted to see at the border what was coming in, how it would be taxed, what were the duty paid challans, invoices, or any kind of a document affidavit which that documents containing. And that itself is a big barrier and what the flow or the quick flow of across the street. On top of this, there was the central sales tax that I mentioned. When there were interstate movement of goods, the central government levy a tax which was within the states, which was called central sales tax, and they brought it down over the years to a small number, but the credit was not allowed. So that went as a loss to the businessman. Now, what is different in GST? GST is like a value-added tax. Whenever the value is added, wherever the value is added, uh, a tax will be levied. So for example, purchased a product and converted it to product existing product B had a different output price, and on that price the tax would be levied and the GST product. And the GST which was on purchase of product A, which was used in the final product B, that GST could be set off against the payment of output GST product. So therefore, you are only paying tax on the value that is added. So this is an important part. VAT also had it, excise also had it, service tax also had it. But VAT and excise did not talk to one another. So the credit flow between these was not possible. For example, I am a chartered accountant. If I purchased goods and I paid VAT on it and they were used in my office, that VAT could not be set off because I was subjected to service tax because I am rendering service. And therefore, on service tax, there was no possibility of claiming the VAT credit. So I would just have to collect service tax from my client and pay it to the government. And the entire cost of VAT for, say, procurement of computers or procurement of paper or anything else, all of that was not possible for taking credit. Now, this would change in a big way in the GST regime. So I think that's a very big positive, but in addition to what I already told you. Also, this changes the basic principle where the taxation was levied at the origin. For example, in case of excise, it was an origin-based tax. Wherever manufacturing happened, when the goods were dispatched, excise was levied. Now there is a shift to consumption-based taxation. So as we know, and this comes more from service tax, and it also comes from international practices, that wherever consumption is happening, the tax would be levied at that point. And of course, the entire taxation flows finally to the point where the final consumption takes place. So, whatever may be the chain, starting from supplier of raw material to somebody who is doing job work, to somebody doing the final manufacture, to somebody who is in the sales pipeline, distributors or stockists or whoever, till it reaches the consumer, that's where the incidence of tax should take place. So that's another concept of value-added tax. It is taxing consumption. So in this case, again, exports would be zero rated, whereas when imports are made, there will be integrated service tax, integrated uh, goods and services tax, which would be levied. So it will be treated as a interstate transaction. So this is some of the big difference which GST is going to bring about. We can look at now the applicability of GST. One of the principles that we can look at is the taxable person who gets taxed under GST. Now, this definition is very important, and depending on who you are, that is how you will get taxed. So, almost everything and every person is the taxing entity, gets taxed under GST with certain exemptions. For example, say medical practitioners are kept out. For example, education, certain type of education is kept out. So certain basic services are kept out. There are also certain goods which are kept out, and the government thinks that at a later stage these goods can be brought in so that the seamless supply of credit flow moves better. such as petroleum and alcohol. So these are taxed at the state level, and they are very large amount in terms of total goods and services. Probably 30-40% of total goods and services would be covered by, say, petroleum products. So those things are kept out. But we hope that later on the tax on it, the GST on it, would be allowed for credit. When we come back to the taxable person where we started, the definition is more or less same as that which is given in the Income Tax Act. So almost all entities, from individuals to companies to trusts, everyone gets taxed. So they all are treated as taxable person. The second definition is taxable supply, and supply is a big change, a big definition, which one needs to understand. Here, the registration is not required if only exempt supplies are there. So now we are not talking about manufacture, we are not talking about rendering of services, we are not talking about sale of goods as under VAT, but we are talking about supply. Supply becomes the key concept for applicability of GST. So if you only have exempt supplies, there is obviously no GST. There is also a threshold to help people who are below a certain amount. They don't have to get registered. That threshold is 20 lakhs right now, other than certain categories in different states. So up to 20 lakhs, as a thumb rule, you can assume that there is no GST registration required and you won't have to charge GST. However, there is compulsory registration in certain cases. For example, if there was interstate supply, then registration is mandatory. If there was a reverse charge, and this is another concept under GST, we'll talk later, then you will have to get compulsory registration. And maybe we can touch upon reverse charge right now. Reverse charge means when you deal with an unregistered dealer, at that point of time, the onus of paying the tax is put and is cast upon the person who is receiving those goods and services. So if you bought some goods from, say, an unregistered dealer, then the idea of the government was that the person who is buyer of those goods will pay tax on it by generating a certain document, pay tax on it, the GST on it, and also take credit because the seller is an unregistered dealer. The whole thing was passed on to the buyer, which is generally not the case. So that's called the reverse charge mechanism. We had that under service tax regime. That has been carried on under GST regime as well. Who else gets compulsory registration? You also have casual taxable persons who make taxable supply can obtain temporary registration. For example, if somebody went to a different state and in that state he was just there to say provide services at an event which was there for say 2 days. Otherwise, you were from state A and you just went to state B to provide a certain service. So you could take casual taxable person registration there. It will be a temporary registration. You discharge your tax liability and then the story is over. The other concept that has come out, and this is a great thing as well as one more number that you will have to remember. We all have PAN numbers in India. After PAN numbers, we had many other numbers such as MAPIN and so on. And the last number that we all have is our Aadhaar number. And now you can say all the businesses have got their Aadhaar number in the form of GSTN. And this is the GST identification number, which is a PAN-based number. It has a state code. It has the 10 digits of PAN. So there are 2 digits, which are first 2 digits, which are state code. After that, the 10 digits are the PAN number. After that, the 13th digit is the business vertical number, and business verticals are defined. Then there is a blank, and the last number is the checksum number. So every person, every business now that is registered would need to keep the GSTN number, and that becomes sort of the business Aadhaar, I guess, if we can call it that way, for the purpose of GST. We come to now the rate part. There are many rates again, and this is primarily because India has the full spectrum of economic inequality, if we can call it that. We have the poorest of poor and we have the richest of rich. We have a very large middle class. We have a very large upper middle class. We have, meaning a sizable upper middle class. We have all the shades in between. So therefore, it was thought fit that GST not have one or two rates, but it has multiple rates. Again, we have a lot of past, and we are a society that is based on customs and what happened in the past. And oh, we were used to this, we were taxed like that. Oh, we only paid 1% tax. How can we now pay 18% tax, and so on? So therefore, multiple rates were kept under GST. So there is the standard rate, which is the 18% rate. Then there is the demerit rate for, say, sin goods, goods that are not really essential. Goods are, more luxury items. On that, 28% is charged. Then there are the merit goods, where 12% is charged. And there are certain goods on which only 5% is charged. These are, day-to-day consumption items, which every single person in this country might be using. On that, there is 5%. Or some are taxed at nil rate also, where there is no tax at all. In addition, there are a few rates in between from 0.25 to some other rates, such as those on gold, etc. So essentially, we can say that there is nil rate, there is 0.25, there is 3%, 5%, 12, 18, and 28. So fortunately and unfortunately, we have multiple rates, and at least for some time, we will have to live with this. And hopefully, in the near future, we will have some merging of those rates, and we may have fewer rates than what we have now. But the biggest thing is that we have at least started with GST. And if you look at it, it's such a huge amount of shift, because every state which had its own right to tax, and the center, which had a massive right to tax, has given up that right and entrusted the GST Council, the body which is created under the constitutional amendment, which amended these rights given to states and center, to bring about GST. So in a way, it's a huge amount of unification, and that's why the government is calling it one nation, one tax, one market. Because of all this, we are actually becoming one nation, and these barriers that were created by the states are now, those shackles are breaking. And because of this, we have at least one tax, which is GST across. So you went to West Bengal or you went to Rajasthan, you will only pay GST, which earlier would be West Bengal sales tax or Rajasthan VAT or whatever. And of course, this allows creation of one market, which is a massive, massive change. Otherwise, the whole market was so fragmented. We can come to some of the key concepts now that we have understood. Of course, this is in no way a complete explanation of the background, but at least it gives you a glimpse of what GST is. And there is a lot of material which is there on YouTube. There is a lot of material on the CBEC website that you can look at to study GST and its concepts and fundamentals. But let's look at some of the key facets, the key components of GST. Like I said, the first one is supply. There is also the point about taxable supply. There are new terms such as mixed supply and composite supply, and these are very interesting points. There is also the constitution null changes, which has brought about GST in a dual manner. So, although I said that we have one GST, technically that's not so. On every goods and services, that GST rate is broken down 50-50 by the state and by the center. So, for example, if you went to the restaurant, which was, say, an air conditioned restaurant, because it has a different rate, you would be paying 9% SGST and 9% CGST, which is central GST. So, that 18% is always divided into two parts. We have another concept, which is the destination based tax concept. We could look at major changes in job work. What is the principle? We have a concept of e-way bill, which is a very nice concept as a principle, and that's not yet triggered, but it is expected to get triggered in October, as we are informed by the government. We have the concept of aggregate turnover, anti-profiteering, casual taxable person, and so on. So we can look at some of those concepts in this second round. So let's look at how the GST structure is made up of first. That basically GST is between intrastate and interstate. If the goods are intrastates, meaning something is sold within one state, then like I said, we will have central GST and state or union territory GST, which is the whole rate divided into two parts, half-half. If there is an interstate supply, then that supply will be subjected to IGST, which is Integrated Goods and Services Tax. Basically, the idea is that the credit embedded in the goods must flow where the goods go. So the credits must go where the goods go, and because the goods are getting taxed, or if the service is flowing, then wherever the flow of that supply is, the credits must flow with it. So that's the basic framework: interstate and intrastate, and these are subjected to IGST or CGST, SGST. Now, how does taxability work? Taxability is dependent on three or four things. First is the nature and place of supply, which we spoke about, whether it's interstate or intrastate. It is also a subject matter of whether it's goods or services. So you will have to classify what you are selling. Is it goods? Is it service? Or it is both? Because certain things could be both. It may not necessarily fit within the definition of goods and service. There are also certain conceptual differences. For example, restaurants are now treated as a service, although they are selling goods. Earlier, you used to pay a VAT component as well as a service tax component. The third way to look at taxability is on category of supply. The taxability happens in a certain way when it is B2B and when it is B2C. And the last point one has to consider is what is the time of supply? What is the point where you treat it as a supply? The other concept that we want to talk about is the credit flow. And one of the main component of any value-added tax is the seamless flow of credit. Now, any kind of a credit that is there on inputs must flow with the goods or services to the next level, till it eventually moves to the final point of sale where consumption happens. This extends to interstate supplies also, meaning the credit is flowing, as well as, for example, in CST, the central sales tax, credit did not flow. However, in IGST, your credit is flowing. Of course, all these things are subject to numerous conditions, and like a lot of other things in India, there are always many conditions to doing anything, and the credit is also subjected to a time limit, so it's not indefinite type of a credit. Let's look at how the credit will be used. meaning there is a certain logic to the use of each of the credit which comes from payment of CGST, SGST, and IGST. And there is a preference, a sequence in which you need to use. For example, the order of utilization of CGST would be that first you claim the input of CGST and then claim the input of IGST and then discharge the liability of CGST. For SGST, it is SGST and IGST. Now, this is very clear because they want to keep all the state matters at the state level and all the central taxes at the central level. So, when you have to discharge the tax liability of CGST, first you utilize against input CGST and IGST. When you have to discharge SGST, which is the state GST, first you discharge the input SGST and IGST. So the setting off of CGST against SGST and SGST against CGST is a problem. The last one is IGST. How do you discharge IGST? Obviously, the first set of utilization should be of IGST. Second, CGST, because the center is monitoring IGST, so they want the central taxes to get set off first. And lastly, if you have any further credit of SGST left, that you will set off against the IGST output tax. Then there are, of course, returns. You have the first returns for the month of July and August, and those dates are widely available in the public domain. The government has given a good amount of relief in sort of shifting the dates and giving more time. There is also a simplistic GSTR 3B, which is a newly prescribed form, possibly in the interim, where a self-declaration can be made for July in by 20th of August. So instead of 10th August, you have up to 20th to disclose your invoice details, and that will be on self-declaration basis. And on 1st and 10th September, you will again have to file GSTR 1, which is on outward supply, and GSTR 2, which is on inward supply. And that's the GSTR 2 is a pre-populated form that will come. In the month of August also, similar thing happens. For the month of August, you will file GSTR 3B, which is a self-declaration, and on 20th and 25th, you will have to file the GSTR 1 and 2 respectively. So the month of September should be very, very tight, because you will have to finally close out July and August both. October onwards, we hope that GSTR 3B will go out, and we will continue to will sort of go back to the older or the initial or the main regime of filing GSTR 1, GSTR 2, and GSTR 3 on 10th, 15th, and 20th. So that should one of the things that you really need to remember is that the GSTR forms are essentially giving to the government your outward, which is your sales and purchases. So essentially, your sales and purchases are getting crystallized when you file in the next month. So those who are trying to play with sales and purchases later on and adjust their books will have a very hard time to adjust things until they come up with a new means to be an evasive taxpayer. Of course, if this data, again, another point that I was thinking, if this data becomes available to your bankers, to other stakeholders, then it will make the economy more tighter, more disciplined, and more compliant. So that way, it's a very good thing that on a monthly basis, you are uploading a very important part of your data, which can be tracked by right now one agency. But if this is shared with income tax, if it's shared with the banks, they would know what's really happening from a different perspective also, although you may be supplying certain details to your banks. But these become more of a confirmation of those details. So you will have to make sure that those data are perfect at the end of those months. Of course, it's not that you can't change that data later on, However, you need to be much more careful while filing this. Then we come to the point of tax invoice. Tax invoice is a very important document. You can treat debit notes, credit notes, other documents such as bill of supply where there are smaller composition dealer who are involved, where there is supply of exempt goods or services. It's like a simplified invoice is part of this invoicing mechanism. There is also a receipt voucher when you receive an advance. So that also is part of the invoice details. The contents of the invoice is GSTIN, which is obviously your main number, which is your tracker. There is also the reference to what is the taxable supply, what is the HSN code, breakup of tax, and whether this is paid under RCM. These are the major things which are put on the tax invoice. Invoice will obviously be prepared in triplicate as we are informed. Now let's come to some of the matters which are important to gem and jewelry industry and some questions that we have received already. You always had the custom duty to start with, and that custom duty was paid at the time of import. Then after GST, custom duty does not go away. So a lot of people felt that whether custom duty is also subsumed. Custom duty is a separate tax. It's completely out of excise, service tax, VAT. It is on imports and you will still be charged at basic custom duty. However, those cesses which were levied on custom duty, the government has recently clarified that these cesses on custom duty have been waived. But what will happen now will be the levy of IGST, and all the imports will be treated as if they were interstate transactions, and therefore integrated GST will be levied on it. You earlier had excise and MVAT if you were, say, in Mumbai. So you had customs, excise, and MVAT. Now you will have customs, just the basic custom duty, and which will not be available for set off. And then you will have the IGST. So at the point of your goods coming out of customs, you will have to discharge IGST. All the goods of Chapter 71, which include diamonds, gold, jewelry, and other rough diamond, they will be subjected to 3% tax. Rough diamond are at 0.25%, and job work and making charges are presently 5%. So basically, anti-dumping duty and safeguard duty could be levied by the government. The CVD and SAD, which were there in the earlier regime, now are no longer there. Imports by SEZ or developers of SEZ are exempt by the notification of 30th June, notification 15 2017 will be exempted from IGST, so they will only be subjected to, there won't be any GST impact. Now what happens with job work? And that's one question. Let's look at something else. Earlier credits of VAT, service tax, excise. That was one question. What happens to those? Those are generally available, including to stage dealers, subject to several conditions. They have also, the government has come out with the credit transfer documents. So if a certain person was the first level dealer who had paid the tax and who has the tax paid document, then he can transfer that credit to the next level if that is required. In case of reverse charge mechanism, the government has given a relief of 5,000 per day will be exempt from reverse charge if you buy those goods or services from unregistered dealers. In case of imports, we have already spoken about. Now let us look at the job work part and then the branch transfer, often that is between, say, Mumbai and Surat. So we'll look at that. Removal of goods for job work can be done in two ways. You can either pay the duty, remove the goods, and then do the same process of bringing it back on your books. That makes it really, really clean because you have paid the duty. The goods, along with the duty, moves to the next location, the next point in the chain. There, some processing happens. Again, a duty is paid, and the goods come to the initial location or the third point in the chain. So that's one way. But there is also a procedure for without payment of duty movement of goods for the purpose of job work. So if one is carrying out job work, you can choose depending on how the flow of input tax credit is, how are the other factors affecting your business. You can take a call. You have done it in the past, so you probably know best how to handle it. Supply of goods after job work will be again subject to tax. It goes without saying. Registration of a job work, whether it's compulsory or optional, if the job work is within your own business entity under the same PAN. For example, you have a job working unit at some place, but if it's interstate, if you had a registration number, say in Surat, then it could be under the same PAN, and that may be a good option. But if you are using an outside job worker, you can also have him register, or you can have another process where you can have sort of a place of I forget the name what it's called, but you can register yourself at that job worker's location. So that's also a point if the job worker is a smaller unit. GST, either forward charge or reverse charge on making charges. So you have two ways to look at it, depending on whom you are dealing with. There is ITC 04, Form GST ITC 04 for quarterly details of goods sent to job worker. That is the procedure you will have to look at and learn for your business. A job worker has to maintain proper accounts in respect of the principal, because now the main part that I did mention earlier is that the whole GST apparatus is computerized. There is very little scope for any paper filing, movement of paper. Everything is going to work through GST network, which will be probably the largest tax network in the world, and it would deal with billions of transactions on a monthly basis. So we hope that that works really well, and because of this, a lot more transparency and a lot more accountability on both sides will get created. So this should make the credit flow, the flow of refund, and all of that much easier, because it will leave a trail of what is happening at what stage. There was a question about if the diamonds are moved from to the branch for polishing and then it comes back for return. And there was also a question about something moving from Surat to Mumbai for export, and Surat to Mumbai for export between two distinct persons. Now the question here, which is most important, is whether uh, both the places which are interstate, because things are not happening within the same state, you should consider whether Surat is registered as a distinct person and Mumbai is registered as a distinct person. If this is within the same company, you could have two GST IN, but the PAN-based registration, both the PANs would be same because the entity is one. Now, when you have the same entity, you could, for example, if you imported something from overseas, you sent it to Surat for some processing, some job work, and brought it back. You have a number of ways to handle this. First is that when you got the goods in Mumbai, you would have probably paid custom duty. You would have discharged your IGST. Then you send it to Surat. You have two options. You could either send it under your invoice, or you can send it as a job worker without payment of duty. At Surat, they could process it further. It could be done at cost, or they could levy something on top of cost. And there is some complication about valuation, etc., for which I have no answer. There is no clarity as such how the government will look at it. But Surat can invoice those goods back uh, based on that distinct person registration, and depending on the input credits available at Surat, because Surat will have, say, some rent, it will have some expenses, it will have certain input goods and services on taxes are paid, then those should be considered, and then you decide how much percentage has to be charged if you want to take all of that credit at Surat and wrap it up at Surat, and then send the goods back along with the job work charges to Mumbai. So basically, you are billing out only the job work charges at Surat and sending the goods back. Now, when the goods come back to Mumbai, you have an option, especially a lot of people might be in export. Then you are going to export it. There is a procedure that is already in place, which is you can pay the duty at the point of export, which will be all the input credits you have got in respect of IGST that is paid on material that has come from Surat. You use that entire credit, you make the payment of duty at the time of export, and then claim refund. There is a promise or some kind of a positive statements made by the government where they are saying that we will refund your money really fast, really soon. So, and of course, this has to be done under a new procedure where a bond, etc., is created, and so that these credits on taxes should come back much faster, and a large percentage comes almost immediately. So that's probably good news. Then we have, of course, export are otherwise zero rated. So what I said works. Uh, you have these two options, but the better option might be that you pay the taxes, use all your input credits through and pay the taxes through those credits, and export the goods under bond, and then claim refund. So this is somewhat similar to what you are used to in the current regime. The government has said again that 90% of the total refund claim would be a provisional refund, and they'll discharge it really quickly. Of course, somebody has asked question about documentation between Mumbai and Surat. I have already discussed some of it, but you will have to look at a lot of details depending on your situation, because general answers may not work in specific situations. For more information, I just want to give you some of the websites that you could look at. There is a CBEC website. There is a CBEC GST website, which is a separate dedicated Central Board of Excise and Customs dedicated website on GST. There is a GSTN website. There is also a CBEC Mitra email where you can send your queries or get some support. There is a GST website which is just gst.gov.in. There are several outreach programs. There is a toll-free helpline, and of course there are Twitter handles that have brought out many answers for people who have posted their queries. Government has also constituted sectoral groups for gem and jewellery. I think that will be a good forum to pass on all your questions and get clarification, so there is better certainty and less litigation, and of course a lot less confusion, especially at the start, so that GST becomes a smooth rollout for everyone. So I thank you for your time. I hope this was useful, and we can take some questions as they come. So I have some questions that have come from quite a lot of people. I'll just read the question and try to answer it. Some questions do have answers and some may not. However, before I start, I just want to tell you that there is a rate finder app that has been brought out by CBEC recently. So it's both available on Android and iOS platforms. So you may want to, check that, and hopefully it's more useful. I haven't downloaded, but that app is also available. There's also very so hopefully that should help a lot of people. Second is that GST, unlike direct taxes, which are taxes on income, these are only meant to be a pass-through, meaning you are collecting from someone and paying it to the government. So essentially, it's not a tax on you. It's not a tax on the business owner. It is a tax that gets collected when consumption happens, when supply happens, when somebody buys a goods or a service. So that distinction is very important to keep in your mind. Also, certain industries have been sort of made dependent on tax benefits. So one almost believes that, until I have this tax benefits to lean on, I won't be able to succeed. So I guess, that mindset will have to undergo change sooner or later. And the last thing I want to point out before we go to the questions is, there is an element of aversion to tax, especially for people who have paid 90% tax and 98% tax and all that. But unless this country pays more tax, we cannot expect too much to happen for a larger development. And also, not just few of us can succeed, because otherwise we would be an island, the haves and the have-nots. And if we see the chasm between the two, it's only increasing. So I guess payment of taxes and then making sure that we are compliant would be really a key aspect of our next 70 years. So let's go to the questions. How is GST going to affect fashion jewelry sales for us? So basically, since GST is levied equally on all fashion jewelry, I don't know why it should affect anyone adversely, negatively, that somebody in Orissa will be able to sell it at lesser value and somebody here may not be, except that if you have a better cost or lesser margin, then obviously market forces will adjust the sales. But GST doesn't really affect sales as such, I feel. How can uneducated people function with GST and all its IT infra? Doesn't that mean more dependence on CAs and accountants? So number one, I think everyone's more or less gotten used to smartphones, and the main reason to bring IT into it is to bring transparency and accountability. And unless IT is there, both these things are not possible. Unless you love going to the department, you love meeting all the babus and having them take you for something that's not right, IT is the only answer. So, and for, I think, uneducated and those who are doing well. So you could be uneducated, but you may have a significant size of business. You can be, employing so many people. That's also possible. And it doesn't require any dependence on CAs or accountants, because sooner or later things are becoming easier with technology. So maybe at the initial stages you may feel that you are dependent, but in the long run that is not going to be the case, considering the way everything is moving. And we have seen that in, say, company law, we have seen that in ROC MCA filing, we have seen that in income tax filings. Over my 20 years, I feel things have become much easier because of IT. Although there are always very disproportionate hiccups in the beginning, but once that settles down, and often it takes 5 to 10 years, it's much easier. Another question is, do you believe that GST rate should be lower, higher, or same for synthetic diamond over natural diamonds? I don't know how the rates are sort of fixed, but the idea was that these rates are not changed drastically from what they were earlier, and you should go through a trade association to these groups that are set up by the government, and I'm sure that you'll be able to bring some kind of balance and some kind of fairness if you believe that present rates are not fair. Another question is, jewelry falls under luxury items, so has the price of jewelry diamonds reduced? Can it? I don't really understand this question. Uh, so I'll skip that. Suddenly there's mushrooming shell companies which have been inactive since years. Are there possibilities that they are trying to evade GST? So how would the governing body control these type of transactions? So long as anything that's done legally, for example, somebody may have 25 lakhs of uh, turnover and they want to stay out of GST, and they start a different firm or they start another business and they shift some of that business somewhere else, and so long as it meets all the legal requirements, uh, uh, it shouldn't actually be treated as a tax evasion ways. But I mean, government is always after more and more tax, and any kind of tax evasion, which is, going beyond the legal mandate, would obviously be taken quite strongly by this government. How will consignment stock be treated under GST? So, if I understand the question, so you have taken the stock on consignment. If you are already a registered person, then that stock is your own stock. I'm not sure how the exact consignment modalities will work, but if this stock is your own and you have taken under a separate GSTN number, and all the risk and reward of these stocks going forward are upon you, then that becomes your input. And when you sell something onward, that will be subjected to GST. Basically, the idea is that the credits cling to the goods wherever they move, whichever state they move to, and wherever the goods go, the credits go along with it. So it will only be a pass through as such, and you shouldn't get impacted unless you have a very imbalanced imputed tax structure, when the input taxes are way too high and the output taxes, meaning output GST, is way too lower. Then you will have a lot of GST piling up in your books. If that's not happening, GST should ideally be just passing through your books. It's coming through inputs and going out through outputs. Congress wanted to bring in GST at the highest rate, 18%. So do you think it's possible after some period that GST rates may come down? I would really think so, that a GST rate should, from all these multiple rates, they should become fewer. GST rate, if government makes more money and more people come into the tax net and everyone's compliant rather than protesting on the streets, then obviously at some point the rates could come down. I don't think going beyond 18% would be a very smart idea. The idea is to bring in more and more people, and if the taxes go very high, like it did in the 80s, where total tax rates were above 90%, we still have people who don't want to pay taxes because it takes generations to wipe out that kind of stupid tax structure where the government literally siphons off, if I can say so, all your money as taxes, and then you have no incentive left to work or carry out any enterprise. Since the value at which packing material is sold will be usually zero price, whether input will be available on GST. So if you are using this packing material for output activities, GST, you can take that credit. Do you estimate that GST would give equal or greater revenue to the government rather than old direct taxes? In the long run, I would say yes, because of more people joining the GST stream, we will have better revenue collection by the government, and also due to better compliance by the existing people, because the leakages will be plugged through this network that is created, the GST network. So there are many other means which government is trying to adopt, that this huge highways of tax evasion, they get closed. um, so if you are doing any kind of exhibition and jewelry sale, which is short term, casual, especially you go to another state, then yes, you should take that casual taxable person registration. Composition scheme, how you can avail that scheme. So those rules are drafted. You could just do a Google search, and composition is a very good scheme. It's very easy. You can just get a very low rate and low compliance so long as you fall within that bracket. So for smaller players, it's a good way to go about things. Um, Advances from customers will be liable to GST. The answer is yes. How about wastage? Will GST 5% will be charged on that? I'm not sure about this question, so I will rather not answer it. Do we need to mention taxable value if goods are supplied to a job worker on delivery challan? So I have given that answer in the presentation. You have two ways to supply the goods. Sometimes it is your own job working facility, or it's a separate job worker. But the idea is that the job worker will charge you just the job work service charges, and not on the goods that you are going to shift all your material there. Selling to an unregistered dealer would mean double taxes paid by me. The answer is obviously no. If you sell anything to an unregistered dealer, you are just selling it, and he's supposed to pay you all the taxes. If you have collected the taxes, that's it. Then it's his problem how he's going to settle that registration issue, because then the government is going to catch him if he is evading any tax. But he could eventually be either consuming it in some way, or he's passing it through. So long as he pays you your taxes and you give his name and other details in your filing, at least you are sort of covered. For sale, I don't see that should be a problem. Goods taken on consignment by us, and then the same goods are again sent on consignment treatment in case goods are exported and imported. Vijaya, I'm not able to understand this question. We can talk later on. Won't the new regime present a deterrent to deal with small unregistered dealer, causing them to go out of business? See, up to 20 lakhs, there is no problem. There are other thresholds for composition where there is 75 lakhs and so on. There is also a scheme where you don't need to keep very detailed invoices and all that for smaller people. Now, what is the definition of smaller unregistered people? If you are, 50 lakhs, 70 lakhs, and if you are given all these facilities by the government to start with, which is a lower rate and almost no compliance, except that you have to file certain things online just to track people, because there is a lot of economy which is not getting tracked. And that's the fear of the government, that a lot of activity happens. These activities are economic activity, but they are out and out. There is no tracking of any of this. So obviously it will seem like a pain, but I don't know why they would go out of business. In fact, smaller business are probably more nimble to change things faster. We issue gold in terms of making charges, so do we need to pay GST on that in case of job work? I don't understand that question. Unregistered dealer, which means goods are expensive for him. Okay, unregistered dealer meaning goods are expensive. Okay, you are just extending your question. Selling to an goods are expensive for him. Yeah, so if he wants to use the credit, obviously he must register, because the government is giving credit, and allowing you to pass on that credit, Harsh, is only when you registered. If you want to play the game, then that unregistered dealer will have to come inside the stadium. He has to come inside the ground, and then he can play the game. So by being a bystander, obviously he will stand to lose, and that's really the idea, that everyone comes inside the game, inside the ground, and plays the game equally. Because a lot of times those who are getting taxed have a disadvantage. For example, if I'm a large or whatever size manufacturer and I'm paying all the taxes, I cannot compete with someone who is not paying any taxes. So for very long time, these people had that disadvantage, that somebody in that little shed on the side, who was not issuing any invoice, who was not buying any kind of a valid set of goods on any valid document, he was able to sell a lot more, whereas I was a compliant person and I was actually losing out. So these kind of issues are meant to be sorted out by the GST system, where all the unregistered people, all people who were actually avoiding taxes, who were evading taxes, who were sort of staying outside the ground and not playing the game by following, where everyone has the same set of rules, they want to be brought in. So I guess we can stop here. We have crossed 5 o'clock, and if you have more questions, you can write to me or call. You can do that through GemAtlas. So I thank you all. Lovely questions, excellent questions. I hope GST makes us all succeed and makes the nation succeed as well. Thank you.
On behalf of GemAtlas, I would like to thank everybody for being such an active participation, and thank you, Mr. Jokhakar, for having this very informative session for us today. With this, we are good to end this session. If you have any queries, you can drop an email to us, and we would be very happy to help you out with those queries. Thank you.